Okay, Dealco borrows $200,000 on September 1st of 2020 from First Bancorp. Monthly interest is $1,200. The loan agreement requires Dealco to pay the interest every 6 months. The first interest payment is due on February 28th of 2021. Okay, so quick question. What is the annual interest rate? Do you know what the annual interest rate is on this loan? It didn't say, but do you know how much is it? No one? Okay, it says $1,200 a month. So here we go, 1,200 times 12 months equals 14,400, right? And the borrowing is $200,000. So 14,400 divided by $200,000 borrowing. That gives you 7.2% annual interest rate. 7.2% annual interest rate. So the interest amount, 1,200 times 12 months, that's annually 14,400, divided by $200,000 loan, that shows the annual interest rate is 7.2%. If you multiply that with 100, that's here, 7.2%. Cool. Okay, so the annual interest rate is 7.2%, and we have monthly interest due of $1,200, and it has to be paid every 6 months. The first one is due on February 28th. So we first borrow this. If we borrow this, the journal entry is debit cash $200,000 and credit debit cash and credit let's say loan payable or note payable. So debit cash 200, credit loan payable or note payable. However, by December 31st, remember, whatever happens in this year, we need to recognize it in this year, including interest. So the interest incurred during these few months is, first of all, how many months? September is included because we borrowed on September 1st. So September, October, November, December, that is 4 months out of 12 months. So $1,200 times 4, that's $4,800 interest expense to be recognized, and interest payable will be $4,800. That's a liability. So expense will increase, liability will increase. Normal balance for liability is credit. If this borrowing is in the middle of September, sometime in the middle of September, then you have to go with days. Let's say you say, okay, that's 3 months plus 10 days. So 3 months plus 10 days, let's say that's 70 days. 70 days out of 360. Make sense? 70 days out of 360, that gives you a ratio. And that will help you to calculate how much interest you need to recognize. So $200,000 times 7.2% times 70 days out of 360. 365 if you like it that way. 1 year, 365. In accounting, we normally use 360 because it's easier, but 365, it's a little bit more accurate. So bottom line, the good thing is because it's September 1st, you don't need to go with days. You can go with months. So September, October, November, December. In February 28th, what would you think the journal entry would be if the payment is paid? So 6 months is $7,200. That's a credit. Cash goes out of pocket, far away on February 28th. The interest payable that we recognize in here needs to be closed. So if you have a paper with you, please make sure every time we do a journal entry, you post it to the T account as we speak. So you can kind of look at every single thing, every single T account while you are looking at the accounting problem. You have to always translate that English into accounting. So in order to translate it, you need to have a paper right now next to you as you are listening to this problem and constantly update your T accounts while we are doing this. So now the interest payable that you have open in here, you need to close it. So close that. That's a debit. Interest expense for the new year, 2000, let's say 11. The new year, you have $2,400 interest expense to recognize, and cash goes out of your pocket. That's February 28th. Let's say, what would be the next 6 months after that, which is August 31st of 2011. So in that time, you have an interest expense again to pay, which is $7,200 to recognize, and cash will be credited again, okay? So as you see, not only I did this problem, but I extended it to additional 2 scenarios that happens after that. And I want you to learn that way. I want you to always ask yourself, what would be happening when we pay this? How about 6 months later? What would be the journal entry if we pay this, okay? So always be proactive. Don't go with the minimum, just the questions asking you. Just always think deeper, okay? Any question? No? Okay. Let's keep going. B, it says, explain the impact of financial statements if the entry is not recorded. So let's go to the original entry. If you don't record this expense, the expense will be understated. If expense is understated, that means profit, income, net income will be overstated. If the net income is overstated, then if this is a corporation, then the retained earning will be overstated eventually in the balance sheet. If you look at the liability, if you don't recognize this liability, the liability also in the balance sheet will be understated. So liability understated, retained earning understated. Those are both, retained earning will be overstated because expense will be understated. So higher retained earning, lower liability. That keeps your accounting equation still balanced. Make sense? But doesn't mean your numbers are right. Your numbers are just nonsense. So even though your equation is equal, but your numbers are just useless because it's not proper recognition of revenues and expenses. So here is the answer. Okay. Let's go to problem 2. Salary expense at Quick Diner Corporation Incorporated is $7,500 per week for a Monday through Friday work week. Employees are paid each Friday. Okay, $7,500 per week for 5 days. And okay, that's like $1,500 a week, I believe, right? Yeah. Okay, here, 7,500 divided by 5 is $1,500 a day, right? And if the company's year end ends on Wednesday, what adjusting entry must it record? So the last payment was Friday. So Monday, Tuesday, Thursday, and ends on Wednesday. Monday, Tuesday, and Wednesday. That's 3 days. So 3 days, Monday, Tuesday, Wednesday, 3 days, they didn't get paid, but it's end of the year. So you need to recognize the salary for these 3 days that they worked, but you didn't pay them. Remember, anything happens in this year stays in this year, right? So 3 days of missing and not paying is times $1,500 a day. That's $4,500 of liability. So the company will recognize the expense under accrual basis, will recognize the expense. So expense will be debited to increase the expense, and liability will be credited to increase the liability. However, next Friday, New Year comes, right? It's already in the new year. So what's going on Friday? On Friday, the salary expense will be recognized for $3,000, which is just 2 days. That's Thursday and Friday, 2 days. But salary payable that we recognized in here already in last year, financial statements needs to be closed. The liability needs to be closed. So here is a credit, here you debit that. You debit that to close the liability, okay? And cash will be paid. Obviously, again, as I said, I want you to have a T account and post this T account as we speak. And you will see the picture of the whole scenario in the T account in front of your eyes, so you can visually confirm what we are talking about. And that visual confirmation is very important because sometimes you have so many transactions that you cannot say, oh, I can kind of imagine the T account. You can't, because there are too many transactions and you're going to lose the track of it. So the only thing is, from the first moment, the moment we do this, you post it to the T account. The moment we do the next transaction on Friday, you post it to the T account. So you can see the visual confirmation, okay? So that's your job right now. You are watching this with me. If there is no question, here says explain the impact of financial statements if it's not recorded. Again, expense will be understated if you don't record this. That means income will be overstated. And if net income is overstated, that means retained earning will be overstated in the balance sheet. And if you don't recognize this liability, the liability will be understated in the balance sheet. Still, the balance sheet will be balanced, but the numbers are wrong. Questions? So as you see in the balance sheet, asset is same asset, doesn't matter. Nothing is changing over there. Your liability will be understated, right? And on the right-hand side, equity will be overstated. So this overstatement and this understatement are washing each other. Your asset equals liability plus equity, right? You might say, oh, my balance sheet is balanced. Yes, but information are wrong. Okay. If there is no question, next problem. Salary expense at Slow Cooker is $6,000 per week for a Tuesday through Sunday work week. So Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. That's 6 weeks. $1,000 per week. That's $1,000 a day. Okay, if the company year end, employees are paid on Sundays, okay? If the company's year end on Tuesday, that means Monday and Tuesday, nothing has been paid. So 6,000 divided by 6 working days, that's $1,000 a day times, Monday is closed. Monday is closed. because they work Tuesday through Sunday. Monday is closed, and then Tuesday is the first day of week for this business. So they just miss 1 day of salary because Monday is closed. They work 6 days. Okay, so 1 day is $1,000. So salary expense will be recognized for just $1,000 and liability will be credited. Again, if you don't do this, so expense will not be recognized. That means expense will be understated. If expense is understated, then income will be overstated. So net income will be overstated. If net income is overstated, then retained earning in the equity will be overstated. And if you don't recognize this liability, the liability will be understated. Make sense? By the way, if you are doing your weekly discussions, I deducted point from some of you. The reason is when you solve a problem, you have to copy this whole thing, right? Copy the whole thing all the way and paste it, right? That's good. But then you have to, like a paragraph, you have to below explain what's going on. You see right now I'm explaining what's going on. Same thing, you have to explain what's going on. It's just solving it, copy paste, you will get partial points. But you need to explain a paragraph below it. What happened? Why you did what you did. Make sense? Okay. Rojo equipment or Rojo equipment, which has an October 31st fiscal year, very important. So fiscal year ends on October 31st. Reports income of $200,000 for the year ended October 31st. On October 31st, Rojo recovers the following. A $2,000 utility bill booked on October 30th was not paid. Okay, this is booked already. It says booked and is not paid. That's fine. As long as you record and book your transaction, doesn't matter if it's paid or not. We are not doing cash basis of accounting. We are doing accrual basis for all problems here, right? So the first bullet point is perfectly fine. It's booked already, so there's nothing to do over there. Rojo has $10,000 note payable with a 12% annual interest rate. Okay. Payments are due every 6 months. The last interest payment was made on June 30th. Okay, now again, using your fingers, start counting. Okay. June is done already. So let's go. July, August, September, October, November, December. That's 6 months. Okay. Let me turn on my camera. You have to do this, otherwise you're gonna make a mistake. And you have to double check that thing. So here we go. Here we go. Here. June 30th is not included. So July, August, September, October, November, December. That's 6 months, right? 6 months. We're good? 6 months. And do it again. Go over the date. It says June 30th. So June is not included. One more time. July, August, September, October, November, December. 6 months. So you double check that and then you do your math, okay? So let me turn off the camera now. Okay, so $10,000, 12%. Payments are due every 6 months. The last interest payment was on June. So 6 months, nothing has been paid yet, but you have to recognize it, right? Because it's incurred. So here, $10,000 times 12% is $1,200 annual interest, right? And that divides by 12 months, whatever it might be. 1,200 divided by 12, it's $100 a month. $100 a month times 4, why 4 months? You see? You have to remember this, highlight this. It says October 31st. That's your end of fiscal year. You see how easy you can make a mistake? October 31st. And this is a mistake that you can easily do without even understanding what happened. So here we go. Let's do it again. So what? No one told me anything. You forgot too, huh? Okay, let's go back again. So June is done, starting July. July, August, September, October. That's 4 months. 4 months. So count it twice. 4 months. July, August, September, October. That's 4 months. Okay. So that was a good mistake to learn from it. So here we go. So it's 4 months. And 4 months of interest expense should be recognized. That's $400. And interest payable will be recognized for $400. Good? Okay. Again, very important moment here. I'm talking too much. That's why I forgot. But if you are reading the problem and you are quiet, so make sure all these important things, write it on your note. End of the year, October 31st. Okay. If you write that, it will stay in your brain. Hey, October 31st, don't forget that. Because normally you easily go to December, right? So that's things that you need to put it on the paper, important stuff. Put all your facts on the paper, on your note. So when you are doing something, you don't forget those important facts. Like end of the year, October 31st. Interest rate, 12%. Principal, $10,000. Make sense? All those things are important, so write them down. Okay, so that's one thing. The next one is Rojos has 4 salaried employees, each paid $800 a week for Monday through Friday work week. Paychecks are distributed on Fridays. October 31st falls in Thursday. So Thursday, so they work for Monday, Tuesday, Wednesday, and Thursday. So they work for 4 days, okay? And there are 4 employees. So 4 employees times $800, that's $3,200 weekly salary, right? $3,200 weekly salary divided by 5 days, it is $640 a day salary. 4 days has been accrued, okay? That's $2,560 of salary expense accrued. So you recognize that expense, the debit, and you recognize the liability by credit. So liability will increase, expense will increase. And what would be the net income for Rojo? So Rojo's, as you see here, reports $200,000 net income. So initially, but later on, we got few bullet points that we need to look at. Bullet point number 1 was perfectly fine, but number 2 and 3 was the issue. So $200,000 minus $400 interest expense, minus $2,560 salary expense. So the net income for this company is $197,040. Okay, good? No questions? Oh, okay, either I'm really good or you are not listening. So hopefully I'm the first option. I'm really good. So don't be shy, please, okay? Let's go to section 4. Revenue collected in advance. If you collect revenue in advance, that's an unearned revenue. You can call it deferred revenue or unearned revenue. Either way is fine. You call it deferred revenue because you are deferring the recognition of revenue to future time. So you call it deferred revenue. At year end, DIJU records an adjusting entry for unearned revenue. If the adjusting entry increases liabilities, what journal entry was recorded when the cash was received? So when cash is received, you have two options to do normally. Either you record that as unearned revenue, which is cash debit, unearned revenue credit, or you record it as revenue momentarily, and then you adjust at the end of the year. So you have two options: either record revenue, all of it right now, or record unearned revenue, all of it right now. No matter which one you choose, at the end of the year, based on accrual method of accounting, you have to do proper adjustments to record revenues that actually earned. Make sense? So it says, if the adjusting entry increases liability. So if the adjusting entry is increasing liability, something like this, that means decreasing revenue and increasing liability. That means on the first day, you are one of those bookkeepers who did this type of journal entry. You recorded the cash that you received and you recorded as revenue, all of it, no matter what. If you are one of those bookkeepers, then at the adjusting moment, at the end of the year, you will reduce the revenue as much as necessary, and you record some form of liability that has not been earned yet. We call it unearned revenue. If the adjusting entry increases revenue, then what would be the initial journal entry when you receive the cash? So if the adjusting entry are increasing revenue, that means you are crediting revenue, right? That means what happened? That means when you receive the cash, you recorded every single dollar as unearned revenue because it didn't, you didn't earn it yet. So you record unearned revenue or deferred revenue. That's fine. But at moment of end of the year, a portion of this unearned revenue will be closed, will be reduced, and the revenue will be recognized. So you have these both options open to you, and you choose whichever you like more. If you like to recognize everything as a revenue and then adjust at the end of the year, that's fine. If you like to recognize liability and then adjust at the end of the year, that's fine also. Any questions? Number 2, VACO. Fiscal year ends on September 30th. Again, it's very important, so highlight that, okay? Don't make a mistake. On September 10, it collects $30,000 for a painting job and credits unearned painting revenue. So that's debit cash, credit, unearned revenue. So put it in your T account. If you have a T account, post it right now. Debit cash, 30,000, credit, unearned revenue, 30,000. As of September 30th, 60% of work has been done. What adjusting entry must VACO record? Okay, per recognition principle in GAAP, per recognition principle in the GAAP says you record the revenue and you recognize the revenue based on percentage of completion. Percentage of completion or satisfaction of the job that you did. So here the percentage of completion is 60%. And you are doing accrual method of accounting, so you have to recognize revenue based on percentage of completion. So 60% of 30,000. How much is that? Here, 30,000 times 60%, that's 18,000. So you need to reduce the liability by $18,000 and credit revenue. So please go ahead and post it to your T account, and you will see the whole picture now. So now in the picture, you will see in your T account, you will see that unearned revenue has a balance of 30 minus 18, should have a balance of what, $12,000, and revenue T account should have a balance of $18,000. And it's very important to do this T account. Again, you see how many times I'm doing this? If you don't do T account, you don't understand what you're doing. Specifically, if it gets a little bit more complicated than this, then you will lose the track of what you are doing. So T account, T account, T account. It's not key, it's T. Let me show you. Let me show you. You see, you should ask questions. Thank you so much. Very good. So here. Yeah. I'm doing this, but now you have to do it yourself, okay? So watch. So I'm reading from the Word document. It says, VACO, fiscal year ends September 30th. So fiscal year important, September 30th, okay? On September 10, it collects $30,000 for painting. So it's collecting $30,000. First of all, we have some cash here, right? So we are collecting $30,000. And we call it as unearned revenue. So in my T account, I put $30,000. Make sense? This is the original journal entry, remember? And then at the end of the year, let me remember, look at the Word document again. I forgot. At the end of the year, 60% of job was completed. So 60% of $30,000 is $18,000 that has been completed. Okay, so I'm gonna go ahead and do the journal entry first. So I'm gonna say, okay, the out of this 30, 18 is completed. So I'm gonna reduce this. How do you reduce this liability? How do you reduce this liability? Debit that, right? So unearned revenue, that's a debit of $18,000 per calculation, 60% of 30. And if you debit that, you have to credit something, right? And what is that? What's the name? The name is, you reduce the unearned revenue to recognize revenue. So then revenue is a good name, revenue. So here we go. It might be sales revenue, it might be construction revenue, online revenue, online sales revenue, retail sales revenue, whatever you want to call it, but it's a revenue anyway. So here is how you deduct this liability and increase the revenue. So let's post this here. After you do the journal entry, you do the post. So the journal entry I'm showing you in the answer on my screen, your job is to Make sure every time we are talking about anything, you put in the T account. As soon as we do a journal entry, you post it to the T account. So unearned revenue will be debited. So that goes in here, $18,000. Revenue, I create a T account here to show that. And that's a credit of $18,000. So how much is the balance right now? The unearned revenue balance right now is $12,000. You see, this is the picture of that problem. The problem is written in English, which is useless. We translate it to accounting to see it. Now I can see it. Seeing it, it's much easier because I can see the T account. I can see the other T account with the balance. I can see the other T account. And that helps me a lot because now all of a sudden, if I have 5 more transactions back to back to back to back, all of a sudden here without a T account, it will be like total loss. I will have no idea what I'm doing. But T account has to be always there on your paper as soon as you start reading it. So the moment you read the problem, you put it in the T account. That's what you do. T account. Yeah, T as a Tom. T as a Tom. T account. Any questions? Okay. So you got the idea what you need to do. So when I'm solving a problem here, you make sure, or even you are solving a problem, you make sure always put it in the T account. What is the $12,000 unearned revenue? It's a liability. It will stay in the balance sheet till you earn it one day. Deferred revenue or unearned revenue, it's a liability. It's a money that you received, but you didn't finish the job. Questions? Okay, one more time. If I do any problem or you do any problem, you read the problem, maybe a sentence, you write the information. Fiscal year, September 30th. It says you received $30,000 and you record it as a liability, you do the T account. You do not continue reading the whole thing. It's wasting time. You read one sentence, you translate it into accounting. You read one more sentence, you translate it into accounting, T accounts. Update your T accounts as you read every single sentence. By end of the question, you already have a very nice, understandable, easy T accounts in front of you. Then you can make a decision what to do. Yes, so you debit unearned revenue in order to reduce it. And why did I, okay, I put that wrong. 30 minus 18 is 12,000. It should be on the other side, sorry. Again, I'm talking too much. Okay, so 30 minus 18 is 12,000. Normal balance for any liability is a credit, so it stays on the credit side. Make sense? Normal balance for any revenue is credit, so it stays on the credit side. Normal balance for any asset is debit, so it stays on the debit side. Yes, you debit unearned revenue to reduce your liability and make it just $12,000 of liability left. Now, this $12,000 of liability, unearned revenue, it will be earned down the road in future, but for now, it's a liability. Questions? Anything? Okay. So again, you need to do this on your paper as I'm showing you a problem. So make sure you have always a note paper next to you. And if this is a problem 2, write problem 2, let's say here, whatever problem it is on the corner. So write it down so you know what problem this is. Okay. Okay, so let's turn off this for now and focus on the problem. So the notebook is your job, okay? Okay. Problem 3. On August 1st, insurance company writes a 2-year policy for the total of $12,000 and receives the entire payment in advance. Okay, so debit cash, $12,000. If insurance company credits revenue for $12,000, so debit cash $12,000, credit revenue for $12,000. What adjusting entry must it record on December 31st? So post it to the T account, please. So revenue, 2 years policy, that's August, and August is included because it's August 1st. So August, September, October, November, December. That's 5 months. So let's do the math a little bit. $12,000 divided by 24 months of policy. That's $500 a month times 5 months passage of time. That's $2,500. Earning $2,500 earning because this is an insurance company. They got $12,000 in advance. They recorded everything as revenue, but not all of it is revenue, right? So at the end of the year, only 4 months is revenue. So they have to reduce the revenue by $9,500, reduce it. That's a debit of revenue. And they credit unearned revenue by $9,500. So revenue will be debited to reduce, and you credit the liability to increase your liability. This way, by end of the year, you properly record correct amount of revenue and correct amount of liability. So please post this to the T account again, and you will see the whole picture as you are doing this. The original journal entry was what? The original journal entry was $12,000 debit and revenue credit. Post it to the T account, and at the end of the year, you do adjusting entry as revenue debit and unearned revenue credit. Questions? On November 1st, ATD enters a 1-year contract to provide security for corp company. Okay, 1-year contract, $12,000 a year. $12,000 a year divided by 12 months. That's $1,000 a month. $1,000 a month. November and December is included. Okay. And receives the first 3 months of payment at signing, which is great. So they got $3,000. If ATD books the payment as revenue, all of it, the whole 3 months that they received, what adjusting entry must it record at the year end? Okay. So originally, they record debit cash and credit revenue. Post this to the T account, please. Okay. Now, at the year end, just 2 months is earned, right? So revenue here is $3,000. That's too much. Only 2 months is earned. So reduce the revenue by $1,000. So in order to reduce the revenue, you debit the revenue by $1,000, and in return, you credit unearned revenue for $1,000. And that's your adjusting entry. So post it to the T account, and you will see now your revenue has $2,000 credit side balance. $2,000 credit side balance. If ATD does not record this adjusting entry, then the revenue will not be reduced. That means revenue will be overstated. And in the income statement, if revenue is overstated, that means net income will be overstated. And if net income is overstated, then in the balance sheet, the retained earning will be overstated. Make sense? And if the retained earning is overstated, something else should be understated in the liability, let's say. And if you don't record this liability, then your liability will be understated. So if I want to copy this answer from previous problems, and bring it in here, I can show you there. So if you don't reduce the revenue, the income statement, the net income will be overstated. In the balance sheet, if you don't reduce this liability, that you see that liability is reduced. If you don't reduce that liability, then liability will be, if you don't record this liability, I mean, if you don't recognize this liability, then liability will be understated, because you don't recognize it. That means liability will be understated. And if liability is understated and equity is overstated, then your equation is balanced, but the information is wrong. So net income will be overstated, and if net income is overstated, that means equity, the retained earning in the equity will be overstated. And if you don't recognize the liability, liability will be understated. Questions? Now, let's look at this scenario. It says, if ATD books the payment as liability on the very first moment, what adjusting entry must it record at the year end? So now draw a line again, show this scenario with a new set of T accounts. So draw T accounts, debit cash for $3,000, and record liability, all of it, for $3,000. So unearned revenue credit. Update your T account. Now 2 months is earned, right? So this liability that you recognized in here has to go down. It's a credit balance, so you have to do debit on liability. So you debit liability to push it down, and you credit revenue to push it up. So revenue goes up, liability goes down. Look at your T account, you will see that your liability is $1,000 credit side balance right now, and your revenue shows $2,000 balance. If you compare scenario A and scenario B, your both T accounts in both scenarios shows the same balance. Look at it. It will show the same balance. So either way, your results are same. If does not record the, so if you don't record the revenue properly, what would happen? So let me copy paste this again. So if you don't record this revenue, so your revenue will be understated, And if revenue is understated, that means net income is understated. Make sense? And if net income is understated, that means your equity will be, the retained earning in the equity will be understated. And if you don't record the reduction of the liability, then your liability will be overstated. So if you don't reduce your liability, liability will be overstated. If you don't recognize revenue, net income will be understated. And because of that, the retained earning in the equity section as a corporation, the retained earning will be understated. Questions? Someone says, if unearned revenue is a liability, what is earned revenue? Earned revenue is revenue as you speak. That's why I like accounting. It's simple English. It says earned revenue or sales revenue or internet revenue or retail revenue or construction revenue. It's revenue. So revenue is revenue. Unearned revenue is a liability, yes. Like deferred revenue or unearned revenue is the same thing. Deferred revenue or unearned revenue, it's the same thing. It's a liability. It's just like accounts payable, just like wage payable, salary payable, utility payable. Those are all liabilities. Okay. Number 5. The following table shows subscriptions revenue for 3 unrelated companies. Beginning balance in unearned subscription revenue is $2,400 in company number 1. Payments received during the year is $40,000. Okay. Subscription revenue earned during the year is $39,000. Okay, so beginning liability was $2,400 plus you received $40,000. That's another liability because you have to finish the job. So the total liability will be $42,400. Earned revenue at the end is 39. So 42,400 minus 39. That will be the unearned revenue balance at the end of the year. So 30,400. Make sense? So you can, again, for this, you can create a T account, put $2,400 on unearned revenue on the credit side, then debit cash, credit $40,000 unearned revenue, right? And at the end of the year, do the adjusting entry, debit the liability unearned revenue by $39,000 and credit revenue by $39,000. You will see in the T account, the remaining balance will be $2,400 plus 40 minus 39, which is $3,400. You want me to show this on the T account? You are fine. And it looks like you're fine. Okay, so in problem number 2, same thing. Your unearned revenue is $3,000. That's debit, cash, credit, unearned revenue. Then, no, sorry. The beginning is $30,000, so just leave $30,000 in your unearned revenue. Then debit cash for $25,000 and credit unearned revenue for that. So now your unearned revenue is $28,000. At the end, you have $4,000 of unearned revenue. That means the rest is earned, right? So 28 unearned less 4,000 ending balance of unearned. 28 minus 4 is $24,000 earned. So here we go. Yeah, 3,000 plus 25 is $28,000 minus 24,000 earned. And 4,000 unearned. Right there, 4,000 unearned. So $28,000 liability minus earned of 24,000. So unearned revenue balance is 4,000. Liability is 4,000. And this is the same thing I told you before. Remember I said BAASE, beginning, added, available, subtract, end. So it's the same thing. Beginning, liability was 2,400, payments received 40,000. So available liability was 42,400, but earned during the year was 39,000. So 42,400 minus earned gives you 3,400 unearned balance. For number 3, it says beginning balance was 4,500 of liability, unearned revenue. We don't know how much payment we received, that's unknown. But we know at the end we have $2,000 of unearned and 25,000 of earned. So 2 plus 25 is 27, right? 27 minus 45 shows you how much money you received over there. So you have to go backwards. 2 plus 25 is 27. 27 minus 45, that shows how much money you received. So here, 4,500 plus some money that you received, we don't know yet, equals 27 minus 25 is 2,000. So 4,500 plus 22,500, we have 27,000 available, $27,000 available liability minus $25,000 earned. So this is $2,000 unearned. And here is the $2,000 unearned. So 2 plus 25, 27, 27 minus 45. That's the cash that we received, which is 22,500. Makes sense? Ignoring dollar amounts, what journal entry may have recorded the payments. So the payment is debited cash for whatever you received during the year and credit liability. So liability will increase. Right? Or you might say, no, I like to debit cash and credit revenue, all of it, if you like. That's one way to do it, but normally in this scenario, I believe this is the way they did it. Make sense? Number 6, on February 1st, Alta collects $60,000 for a job and credits revenue. Okay, so do the T account, please. Debit cash, credit revenue, post it to the T account. Debit cash, credit revenue, $60,000, post it to the T account. As of April 30th, Alta's year end, 45% of the work is completed. So 45% of this revenue that you recognize is completed, not 100%. So you have to adjust. What adjusting entry does Alta record on April 30th? So 60,000 times 45% is $27,000 revenue. Must be recognized, okay? But you have recognized how much already? 60. So your 60 has to be 27. Make sense? Your 60 has to be 27. So how do you make your 60 to become 27? Okay, let me do this on the T account again. Hopefully that helps you. Okay. So the company received cash and recognized revenue, $60,000 cash and recognized revenue, $60,000, right? And then at the end of the year, 45%, I believe it says it's earned. Let me look at the Word document again. 45%, yes. So $60,000 times 45%, that's $27,000, right? So how do you make this revenue from $60,000 to become $27,000? How do you make this happen? In order to make this from 60 to 27, you need to reduce it. And in order to reduce it, you have to recognize unearned revenue. Make sense? How much? 60 minus 27 is 33. So you reduce your revenue and you increase your liability. So how much revenue do you have now? 60 on the credit side, less 33 on the debit side. That's 27 on the credit side. Check. Got it? So when you are reading the problem and I'm showing you the problem, you have to do this T account. If you don't know what you are doing and you will get lost and you don't have mastery of the subject matter. Questions, please. Anything on this screen? Questions? Okay. Okay, that was section 3 and 4. We cover section 5 next time. Okay? Have a good day. See you next. Bye-bye.